Let's talk about homeowners insurance for a minute. So homeowners insurance is something that's required on every loan. It's essentially if your house were to burn down, it's how to replace it, right? We need to make sure that there's insurance there in place, okay? There's two types of insurance. So there's typically an HO3 policy and an HO6 policy. An HO3 policy is kind of normal homeowners insurance, right? If your house burns down, that's the one that covers it. An HO6 policy is essentially renter's insurance. And obviously you're not renting the home because you're buying it, but sometimes on a townhome or condo, the HOA will cover, will have insurance built into that HOA so that if the house burns down, because obviously you're collectively one big house, right? A condo or townhome, you're attached to other houses. So if that burns down, all of them will burn down most likely. And so the replacement cost is all covered under that HOA insurance. So you would have a separate policy for essentially your belongings. That's why it's called a renter's policy. It's essentially for walls in, okay? So that's an HO6 policy. So two different types. So what will happen is, again, on most loans, we're gonna ask for a normal homeowner's insurance policy, which is an HO3 policy. And so you'll talk to whoever you want. We can recommend somebody to you. You can also talk to whoever you have your auto insurance with to maybe bundle it together. That's up to you. But you'll talk to them and get a quote for insurance, okay? And then what you're gonna wanna do is finalize that quote also, because we can't close a loan with just a quote. We have to have it actually finalized. So make sure you don't just get a quote, but you actually finalize it. Sometimes they'll want a copy of the appraisal, so you might have to wait till that's done. Some don't care, and so you can just go off of that. But essentially you're gonna have that quote finalized, and that doesn't mean you have to start paying for it yet, because you'll have the effective date be the close date. So if we're not closing for another month, well, you don't put the effective date of the insurance as today, you'll put it as a month out, right? Or whatever that closing date is, okay? That's when you will have for the homeowner's insurance. So once you get that to us, then we're able to make sure that the house is insured. An important thing is when you're figuring out how much coverage to get, we need to make sure that the house is able to be replaced like I said, in the case of a fire or something like that. So if you're buying a house for $500,000, we need to make sure that the replacement cost is $500,000 or above, okay? Now, sometimes insurance companies will actually insure you for less than that $500,000 because they're gonna say, hey, the land is worth $200, so really to build the house again, it's $300. And that's fine, but you have to also then get us what's called a replacement cost estimator, okay? Essentially that tells us, hey, we figured out this formula, and we say, hey, to build this house again, it's going to cost only $300,000, and so that's how we're basing this off of. Okay, so if the insurance is not for as much as the house, make sure that you get that replacement cost estimator. That way, we know, hey, again, you're covered, right? That's what we're trying to do, is just make sure that you have adequate insurance. Okay, now insurance is going to be part of your payment, so every month. You'll have escrows on the payment, and part of that money will go towards homeowner's insurance. You will pay your homeowner's insurance a year in advance. So when we close on your loan, you're going to be paying it up front for a year. Okay, that's one of the closing costs essentially, is a year's worth of homeowner's insurance. And then, like I said, every month we'll collect a little bit so that next year when your homeowner's insurance is due again, there's enough money in there to pay for that homeowner's insurance. So this is really all about insurance. I guess the last thing I will say is one of the things we're going to want to make sure on there is a mortgagee clause. So, which essentially, if you just have your insurance company talk to us, we can help them with that. But the mortgagee clause is whatever lender we set you up with, we're going to put them as the mortgagee. And the reason for that is if your house burns down, we want to make sure that you don't just get $300,000 and walk away and not rebuild the house, right? And so when there's a mortgagee on there, they make sure that, okay, the insurance money doesn't go to just you, it also goes to the mortgage holder, okay? Because they want to make sure you're going to replace the house, okay? If a house burns down, the insurance money goes to replace the house, okay? Because obviously there's a loan on it, and they want to make sure that the thing that they've put a lien against is still valid and still worth that money. So that's homeowners insurance. If you have any other questions, feel free to comment below. We can always record more videos and stuff like that, or I can answer in the comment section. But hopefully this helps you get a good idea of what homeowners insurance is and why we need it and some of those ins and outs of it.